Are you afraid of making mistakes with your investments so that you will not have enough money to retire one day? In this video, I'm going to share with you 5 very common investment mistakes that investors make. After investing for almost 40 years, I share what I've learned from that journey and also from creating multiple income streams outside of mainstream investing for the past 15 years. In this video, I'm going to share with you those 5 investing mistakes and the solutions to each of those mistakes so that you don't have to worry about making them because you know how to avoid them. The very first mistake that I'm going to share is not taking advantage of cheap assets. What I mean by that is cheap assets come along once every, well, maybe twice a decade. Depends on which decade it is. And during that time, investors are really afraid to invest in that particular asset because it's dropped down, it's lost a lot of value, and people are afraid to invest in it, but it's so cheap, and it may be the same asset that just a year or two earlier was twice as much as it cost, or 3 times as much as it cost. But there's a lot of fear around buying it. So investors tend to not take advantage of cheap assets when they go on sale once or twice a decade. Now, looking back over my lifetime, or my investing lifetime, which, as I said, it's been almost 40 years now, I can remember specific examples of times when there were cheap assets. For example, in the mid-early 1990s, we were in Houston, Texas, and condominiums were selling for around $30,000 to $35,000, and those same condominiums rented for over $400 a month. Anyone could see that that was, from an initial look, a good investment. It was a cheap investment. This was a good area in Houston, a nice area. I had actually lived there myself, and that was an opportunity to buy cheap assets. Now, the reason is because oil prices were low and they had affected the economy in Houston. And so those opportunities come along once or twice a decade. Looking back over my investing career, I can specifically see those times where I said, wow, assets were cheap. March of 2009, after that horrific second bear market we had in the first decades of the 2000s, stocks were cheap, super, super cheap. And so looking back, it's crystal clear. So the thing is to have an awareness of how those markets, the various markets, move in these cycles so that when they are cheap, you can recognize it. Now, there's a difference between a quality asset being cheap and a not quality asset being cheap, right? You don't want to lose your money and throw it into an investment because it's poor quality and the company goes broke. So there is the whole issue of being diversified and being safe and doing your research. But let's remember that the same quality assets can be half the value, 2/3 the value, even 30 or 40% of the value that they were just a year or two prior. And so the key there is to research and be aware and understand how those opportunities come along and the cycles in the various markets. So that's not taking advantage of cheap assets, and that's the solution for overcoming that. The next investing mistake that a lot of people make is waiting too late to invest. So what happens is a lot of people get busy with life. I think we all do. And by the time we know it, the kids are grown and there's, all these expenses along the way. And there wasn't an opportunity, or an opportunity wasn't created to put aside money to invest. So people think that I can wait until later, but the longer your money has to compound, the better it is. Now, I'm not going to talk a whole lot about this one because it's an investing mistake that is very, very common. And if you've already figured that out, then you're probably not really looking for clarification on that mistake. What you're looking for are answers on how to change that one. So in hindsight, the solution, I would say, in hindsight, is to move to plan B, which I talk about in another video, and create multiple income streams that generate wealth and or more strategic wealth building strategies that will work to help you catch up to where you were before. And that's a lot of what I write about at retirecertain.com. So check that out. The next third mistake I want to share with you in this video, it's so huge. It's not checking the overall market before investing in any asset. Now this ties back to investing mistake number one, where not buying cheap assets was number one. With this particular mistake, what happens is people say, I'm ready to invest. I got this bonus, or I got this inheritance, or it's time for me to get serious about investing, and I'm going to go ahead and invest, and I know I can't time the markets, and I've always heard that, and so I'm just going to put all this money into stocks because I know that will be the thing to do. And so the older you are, the more important this is, and markets move in fairly predictable, or I should say somewhat predictable trends. But it's easy to see when a market is overvalued by looking at some simple and very common free tools, right? For example, the stock market, the PE ratio or the KPE ratio tells you the valuation of the market. So by ignoring that and putting money into a market without first checking the valuation, that's the mistake. And you can overcome that by being aware of, or just checking into, hey, I want to put some money into stocks. I got a big bonus or a big inheritance, and I'm ready to put this money into stocks. And I see the PE ratio now is, 25, and historically it's 17, but it was as low as, 10. You've got an idea of where it is, and that's a really easy thing to do. The same thing can be said for real estate, only it's a little bit different. I mean, you can see when real estate is overvalued or undervalued based on the number for sale signs, right? You can see what's going on by just taking a look. It's very logical. So that mistake, not checking the valuation or the value of any market that you're investing in, can be overcome simply by taking the time to look at it and looking at some simple either valuation tools or the overall market. The next mistake is simply to giving credit to an overall, the overall market, or giving credit to a strategy, an investment strategy versus the overall market. So what I mean by this, been there, done that, is, you invest in something and it does great, right? So you pick out, say 5 stocks, for example, and they all do fantastic over the next, 4 or 5 years. Your money doubles and triples perhaps, and you're feeling like, wow, I am a good investor. This is something I'm going to do, and I'm going to double up and put more money in there because this is just crazy. I haven't done this before. And you throw more money in. Well, guess what's happened? The market has reached back up. It's gotten very, very expensive, going back to the third mistake. And you throw the money in at the top, maybe double up on it, and then the market heads into a bear market and it corrects, or bear market, which is bigger than a correction. And you end up being, only slightly ahead of where you started in the first place. So it's thinking that you're a great investor, or an investment strategy that you've seen is a great investment strategy, whether that's a fund or a financial advisor or some sort of any type of investment strategy, thinking that it's really great when the overall market is what was really great, and anybody could have bought into an index fund and it would have performed equally well, probably for less money and with less effort during that same time frame. So the way to avoid this investing mistake is simply to be aware of the overall market. It really relates back to investing mistake number 3. And when you're aware of the overall market and you know how it has performed, you can evaluate an investment strategy or your own investing skills appropriately, right? And more accurately, because you know well, wow, any investment I made would have done great as long as I was invested in stocks. Now, of course, there's some variation. You know, certain stocks will lead the market. They'll do better than the index fund. Absolutely. But overall, it's giving credit to the overall market and instead of, you know, the investment strategy during times when the market is really soaring. Another example of this would be buying real estate, really any asset. This same principle can be applied to. And then the last investment mistake I'll cover in this video is simply buying the right investment at the wrong time. So, for example, gosh, back, maybe over 20 years ago, 25 years ago, I was investing in mutual funds and I picked out some really good, I did a lot of research and I picked out some really good mutual funds, but there was a rotation from value funds to growth funds, or growth funds were very, very popular at the time, I should say. And I thought, well, you know, these just haven't done very well. And it was because growth had been much more popular. They were really great funds. And when the growth phase ended and value took over, then those funds I had picked out did really, really well. And so, but I had sold them. And so I really learned the value of investing at the right thing, in the right thing at the right time. And you can invest in the right thing. It can be a brilliant analysis, an investment, a great fund, a great property, a great house, a great bond, stock, whatever it is, but it can be at the wrong time. And that makes the investment not perform well. You can lose your money. You can be subject to a bear market or declining value, which declines your net worth. So that's investing mistake number 5. The way to overcome it, several of these really relate to each other in this particular video. The way to overcome it is simply to be aware of really broad trends. I'm not talking about market timing. I'm talking about trends that happen over months and years, and being aware of what's happening in the overall economy, and that affects what's happening in the overall market. So it's having an awareness, and it really goes back to lesson or investing mistake 3, where you're checking to see the value of an overall asset class or overall market before you put money into it. That's what I wanted to share with you in this video, these 5 mistakes. And if you like this information and found it helpful, I would just love it if you would click the little thumbs up button in the bottom corner of the video and subscribe to my channel. Thank you for watching. I'll see you at retirecertain.com.